Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Mr. John Casmon. And John is a real estate entrepreneur who has partnered with busy professionals to invest in over $100 million worth of apartments. John also consulted active multifamily investors to help them start to grow their business. He hosts the Multifamily Insight podcast, formerly the Target Market Insights, and is the co-creator of the Midwest Real Estate Networking Summit. Prior to becoming a full-time investor, John worked in corporate America and oversaw the marketing campaigns for General Motors, Nike, and Coors Light. So, John, welcome to the show.
Hey, Keith, thanks for having me. Excited to be here and excited to share a little bit more for the Wealth Flow audience.
Awesome. And I usually always start, John, with just, everybody's background. I love to hear where people grew up, kind of what influences them, and then, what led you to real estate?
Yeah, man. So I'm born and raised in Cleveland, Ohio, this hometown. So a lot of love, a lot of pride being there. And, Clevelanders are pretty tough individuals. We go through a lot. National media always wants to paint us as losers, to put it frankly. But
right.
We're tough-minded people. We're really gritty, hardworking, blue collar. That's kind of the mentality. Father's blue collar guy, worked in factory for a long time. That's kind of the mentality, right? You bust your tail, you work hard, and keep your head down, and you do good things. So that was my mentality. And growing up, we didn't have a whole lot. I was actually on free lunch, in high school, and I didn't really understand that we were, I think, lower middle class is a technical term. I think if you really looked at the numbers, we probably fell into that poverty bucket.
Right.
The reality is it just wasn't a lot of money growing up. So that was always kind of a part of my journey, right? You just didn't ask for stuff. I remember specifically when there were field trips or things like that, I didn't even like telling my mom there was a field trip. And in my mind, I was like, oh, well, I just won't go on the field trip. And I wouldn't tell her because it'd be like $5, but $5 was a lot. That $5 probably meant that she wasn't, she couldn't have money for parking or whatever it was. And I felt the strain, right, as a kid. And I think that always kind of stuck with me to say, you know what, as I grow older, I don't want to feel like this. I started working when I was 13 years old. I'm my first job at 13. I pretty much was working ever since. Yeah. So I've been, working since I was 13. And again, that's kind of the fabric. So fast forward, first person in my family to go to college, graduate from college. And, I ended up working on the agency side and marketing and advertising. And I worked on the agency side and I ended up getting hired at General Motors, and I replaced my old client. The irony, or however you want to look at the story, is my father worked at a Buick dealership for about 15 years. So I went on and actually became the Buick advertising manager. So it was kind of a cool full cycle.
That is cool. Yeah.
It was cool until it wasn't cool. And that was when we went into bankruptcy.
Oh, wow.
I was there when we went into bankruptcy. And I remember just, I kind of felt like I'd quote unquote made it, even though I wasn't making that much money, but I was, I didn't have to worry about meals, right? I was doing okay financially. I had a great job, I had a great trajectory of where I was going with my career. But I'm looking at the news and I'm watching my boss's boss on CNN and Fox News and MSNBC and talking about the state of the business and that, if we didn't sell a certain number of vehicles, we were going to go through bankruptcy. And she wasn't sure what that meant for us. And sure enough, we ended up having to lay off a number of employees. And there was a guy who sat kind of kitty corner to me, and he ended up getting let go. And I remember him leaving a voicemail for everybody on the floor. And that voicemail changed my life. He had been with the company for 22 years and they let him go. You had to be at like 25 years, I think, to get some of the long-term benefits. So he fell just short of that. He was diabetic. He didn't know how he was going to pay for his insulin. And it was a bunch of stuff like that. And I remember feeling two things. One is a great sense of empathy for him and what he was going through. But the second feeling I had was, I never want to be in this position, and at the time I didn't have kids. I wasn't married. So I felt like I had the ability to make a change. And I think that's the first thing I'd want to really imprint on everyone listening is, this was a huge company, right? And we can all look back and say, oh, well, GM made, challenges, or the automotive industry did this or whatever. But the reality is I was at a big corporation that was too big to fail. And here we went through bankruptcy. And in this current time frame, we know a lot of people in the tech industry and other industries that are also going through bankruptcies or closures or layoffs. And the reality is no matter how good you are at your W-2 job, at some point, either because of, the company, the industry, or you may just age out, or you may, from a political standpoint, you just may not be someone's guy or girl, and you can get pushed to the side. And I think it's really important for all of us to take control of our financial future. And that's what I decided in that moment, was to take control of my financial future. And that ultimately led me to real estate.
Okay, fantastic. So when you left Buick, did you go to Coors Light or Nike, or what did that look like before?
So obviously when I was watching the news and if you recall that time, right, it was a slow process, right? I think it was like April or May when the financial implications started to come out, and it wasn't until the following year that we actually went through kind of an organized bankruptcy. So I had a lot of time to think about my future. And during that time, like any competent individual, I updated my resume and I tried to see what other jobs were out there, right? This looks like a sinking boat. I got to get off this thing. And sure enough, no one was hiring. Nobody was looking. There was one company that I was looking at going to. But in short, it just made more sense for me to try to ride it out and kind of wait for the next wave of opportunity. Because eventually I realized this wasn't just my company. It wasn't just the automotive industry, but this was a total U.S. economic meltdown that was taking place, which I didn't realize at first. So once we kind of got through that and things started turning around, I knew I wanted to leave Detroit because it was really driven by the automotive industry. And I wanted to diversify my own experiences, diversify my resume, but then also start investing in real estate. So I ended up moving to Chicago, and I worked for an advertising agency, a smaller boutique agency where I worked on those brands you mentioned, Coors Light, Nike, Mountain Dew, these different brands. And on the agency side, I kind of led campaigns for those groups. And I left with my head high when I left GM because I was the youngest advertising manager there. I was recognized as one of the top advertising and marketing professionals by Black Enterprise Magazine. I was a part of the team that made Buick the fastest growing brand in America. So we had a lot of success. So I felt like when I left the company, I left them better than I found them. I left with, a lot of accolades, great relationships. So I felt pretty good when I made that transition, but it was very intentional. It wasn't just to go to this company. I wanted to work for a smaller agency that was more entrepreneurial, didn't have some of the political, limitations that a large corporation has, but I also wanted to be able to talk to the CEO. And I wanted to learn directly from that CEO and, just wanted to kind of grow and take some of the things that I felt I needed to develop and be in a more, let's call it hungry environment, when you work for a small company, you lose one client, 25-50% of the staff could get let go. So every day it was hunting, right? And I felt like that was a skill I needed to develop. And I did. I spent a lot of time at that agency and developed those skills. And that certainly helped me when it came to real estate.
Yeah. So when it did come to real estate, what did you go straight into multifamily, or did you start in single family, or kind of what did that journey look like for you?
So I read Rich Dad Poor Dad soon after I got out of college, and great book. It helped me understand my financial upbringing, which it was non-existent, right, for a lot of people, right? But for me, I saw my father just work his tail off, right? He worked third shift. And when I thought about people who had money, at least in my mind, which was like the depiction I had from like movies and TV, right? But when I thought of people who had money, there were people who invested in the stock market and read the Wall Street Journal and read the New York Times, right? In my mind, that's what rich people did. So
Right.
I would wonder, like, I don't think I've seen my dad read the sports section once or twice, but that's not really his thing. I don't think he owned any stocks, right? So that book kind of unlocked a big piece of the puzzle for me that maybe separated those who are successful from those who aren't. So from that book, when I was at GM and I saw my colleague get let go, it really flashed me back to reading that book. And the book was one of those, it's like anything, right? You read a book, you get some great insight. Oh, that's great. Like, that's really good information. But you still need a push or a trigger. You need a trigger that says, no, I need to take this from a good insight to something I need to put in action. And at that moment, when I thought about how do I protect myself from this happening to me, I flashed back to the book, I flashed back to real estate, and I started to devise a plan to begin investing in real estate. So the other part of the moving to Chicago was I didn't feel comfortable investing in Detroit real estate in 2011. So moving to Chicago was a place that I had lived in before, and I wanted to invest in real estate. So my wife and I, we started attending networking events, going to RIAs, which are Real Estate Investing Association events, reading books that we could find. And then ultimately we bought our first property, which was a 2-unit property. We house hacked it, living in one unit, renting out the other unit. And the reason we loved this strategy was twofold. One, every book I read, especially multifamily books, everyone who invested in single family, they always said they wish they moved to multifamily sooner. And every person I've ever talked to, they all said, I wish I went to multifamily sooner. So as we thought about it, it's like, well, why don't we just start multifamily? Even if it's smaller multifamily, like, why not just start there? Yeah. And so that's what we did. We bought a 2-unit. The other thing that was great was the 2-unit allowed us to use a great program called FHA. And the FHA financing allowed us to use just 3.5% down. We were able to get, I don't know what the interest rate was, but we bought this $362,000 property with basically $10,000 out of pocket. So great incredible deal, great opportunity for us to get started. And then keep in mind, this is 2012. So this is really at the low point of the market where it's starting to pick back up. So we got a lot of appreciation of that property. So some of it was luck, obviously, but you got to put yourself in a position to be lucky. You got to buy that property. You got to take it from, again, an idea or a thought to action. And we were able to do that. So from there, it was a matter of, okay, how do we replicate this? So we bought a 3-unit property. And then it was like, okay, well, this is going great. How do we really scale this thing? Well, we need to go commercial. We need to go 5+ units. We took equity from that first property and bought an 8-unit property. And then we hired a professional management company and other folks to kind of help us manage that as well. And that was really the impetus of, okay, how do we make this a business? I like what I'm doing in my day job, but this is the future. Real estate investing, buying apartment buildings, working with investors. This is going to be the future, not necessarily doing advertising campaigns. So how do I do that? And that's really where I started to invest in that portion of the business, both personally, professionally, but really trying to surround myself with people who are in that space so we could create this as a real business.
Yeah. It's great. And yes, I think it's fantastic that you started with multifamily. And, I always look at it as, with single family, you've got a potential renter if you're going to, hold and rent to a long-term tenant. But when they move out, you may have repairs, you may have this, right? And so, or if they lose a job, whatever. And I always equate it to like a single cylinder, right? On a vehicle, you're just having one cylinder going, and that's what's going to catapult you forward versus, if you were to have 8 cylinders, or, in your case, initially 2 cylinders, right? One can be vacant and you still are earning the income. So that's fantastic.
And I will tell you, I think the thing that's really important for everyone, you've got to figure out what investing strategy works for you, but start by understanding your goal. And your goal can be either the thing you desire or the thing you fear. And I was coming from a place of fear first and foremost, which was I don't want to wake up one day, find a pink slip and say, oh crap, how am I going to take care of my family? And because of that, what I was trying to do with my investing was replace my income or at least replace enough of my income to cover my living expenses. Yeah. So when you think about that from a single family house standpoint, if you're buying a house and it cash flows, let's say $200, $300 a month, how many houses do you need to replace your W-2 income?
Right.
That's the way you need to think about it. And when you look at it from a practicality standpoint, it becomes clear that, hey, I'm probably better off buying a couple multifamily properties than, 10 houses or whatever that is, because I can reach my number faster. And then it kind of came into, okay, well, what's stopping you from buying more properties or buying these bigger properties? Well, okay, I don't have all the capital to do that. So that's where it goes into, okay, well, what if we partner with other people, right? So that's kind of the journey I started going down. And it's not to say it's right or wrong, but for me, it all came from protecting myself from, unknown circumstances, and for me, it was job loss. But what if I got sick, or what if we're from Ohio now, but I was living in Chicago? Well, there aren't really many good advertising jobs in different markets, right? There's like 5 markets where you can get really good advertising jobs. You mentioned the brands I worked on, right? GM, Coors Light, Mountain Dew, Nike. I was working on big brands, right? Big budgets and great productions. In Ohio, here in Cincy, there's P&G. But outside of that, the biggest brand I was going to work on in Cleveland, where I'm from, is Sherwin-Williams, or Smuckers. And, no offense to those brands, but you don't go from doing $100 million advertising campaign, going to the Super Bowl and, working on with LeBron James and all this kind of stuff to Smuckers. So I was like, I'm not going to stay in this industry doing jelly. I'm just not. So, when I made that transition for me mentally, it was also, I need to isolate myself from this industry completely. I need to find a way for me to move to Ohio and be able to continue to make it here. And again, I had to go bigger to make that happen. So, if you're thinking about your own investing strategy, I would advise you to think about your goals. How much money do you need? Whatever it is. If it's just play money, great. If it's retirement money, if it's college fund, what do you need? And then what's going to be the best path to help you get there?
Yeah, I think that's great. Even if you're not wanting to leave your W-2, I in our intro to the podcast, it talks about, being able to sleep better at night because you're job optional, right? Because you've built enough passive income that, heaven forbid, something does happen to you. You're putting yourself just in a lot better position to be able to maneuver around it. So.
Yeah, you're spot on there. And that part is so key, because when you really start thinking about it at a higher level, if you have a great job, I'll give you a real life example. My brother, who's, obviously my brother-in-law, he broke his hand. He's a surgeon, but he broke his hand recently. And obviously he's not doing any surgeries. Now he can still practice and do other things. He's got, residents or whatever you call them, the other people who help him, but he can't do any surgeries right now for the next 6 months. And that's one of those things where, what if you suffer an injury? What if you go through a situation where you physically can't do your job? That's not something we plan on. I talked about being fired or let go from the company, but what if something happens to us? I just interviewed someone the other day who, her husband found out in his early 30s that he had Parkinson's. And he was a day laborer where he used his hands. So that's not something they can plan for long term. So it's not to say that you have to quit your job and go the fire route and be financially independent. If you love your job, keep making your money, but also start to invest in assets that give you options. And if you can do that passively, that's even better, because most of us don't want a second job. It's not to say, hey, work your 8-10 hours a day and then go work another 2 or 3 hours or 4 hours being a landlord. Very few people actually want that, right? We want the money. Give us the money, give us the asset. I don't need the headaches of dealing with these tenants. So in that case, passively investing is a great option for you.
Yeah, for sure. Well, and so you started out with smaller multifamily. I'm assuming with 100 million worth of apartment complexes. We somehow got from a few, duplexes and triplexes up to something much larger. So, tell me a little bit about that journey as well. What brought you from small multi to larger?
So you probably interview a lot of people talk about mindset, and mindset and, real estate's a team sport and all that kind of stuff, right? It's so true. And it's so cliche. But cliches are cliches for a reason. And
That's right.
takes a minute to really process a lot of that information. And for me, that's why I say it was so important to start surrounding myself with people who are playing the game at a different level, because it made it realistic and tangible for me. I would read these books, and there was actually a book by Ken McElroy, ABC's of Real Estate Investing. Great book. One of the first books I read when I got serious about scaling in this business. And he's like, oh, you're basically saying your first deal could be 100 units. And I was like, what is this dude on? Like, no one's first deal is going to be 100 units, right? This is the most ridiculous thing I've ever read. And sure, if you're super rich and, you can live with whatever happens. Sure, maybe your first deal could be 100 units. But for most of us hardworking professionals who, are earning a low six figure income, we're not willing to, one, we don't have the capital to go out there and buy a property that big by ourselves starting out. And it might be too risky without the experience. That was my logic, which again, makes sense, right? That's pretty logical.
It is. Yeah.
The problem is that when you're around people who start playing the game at a different level, it opens you up to seeing different opportunities and to break down maybe some of those perceptions that we have, or those limiting beliefs. And by being around these people and seeing it and then reinforcing that with the education, it made me realize that, okay, let's not look at it as this giant mountain we've got to climb. Let's look at it as, here's what we're going to do to go forward. And let's kind of open ourselves up to opportunities as they present themselves. So I went from that 8-unit deal, which we kind of owned ourselves. We hired a property management company. And then as we started to learn about working with other investors, raising capital, partnering with others, we hired a mentor. We're around our mentor, I'm around my mentor's other clients. And we got to be pretty good friends with another group. And about 6 or 7 months went by. And then I launched my podcast, and they came on as guests separately. They came on, and they had a deal they were working on, and it was a much larger deal. And I offered to help and be involved in that deal. One, because I believed in them. I liked what they had done. They had a pretty good track record starting out. Two, at this point, I had been talking to my own investors, and they were interested in investing, but we were having a hard time finding deals that penciled and met our deal criteria. They were actually in your backyard. They're in San Antonio. I like the San Antonio market a lot. Had great fundamentals, great growing market. So we ended up partnering with them, and that was on 192 units. Now, on paper, it's asinine to go from 8 units to 192 units as your next deal. But the reality is, this is a team sport. And if you're open-minded in how you do it and you partner with other people, anything is possible. So that's exactly what we did. Went from 8 units to 192 units. I think the next deal we did was, we did a 28 unit that we led here in Cincinnati. We did another GP deal at 388 units, and then it kind of just took off from there. So the key for me was being open-minded to how we do deals, but also focusing on our investors, figuring out how do we take care of them? How do we find deals and opportunities that meet their investing criteria while also protecting their interests?
Yeah, no, that's great advice. And you're right. It is a team sport, and where you may have the experience of buying the smaller stuff by partnering with somebody who's already doing larger stuff. Automatically, you kind of level up, right? You kind of get up to where their level is, and it allows you to just do bigger things. It's a lot easier to lift something big like that when you've got somebody who's used to doing it. So,
absolutely.
Yeah. And so, I guess tell me a little bit about your portfolio now, as far as, obviously you had the deal in San Antonio, Cincinnati. What, geographically, where are you investing right now?
So we invest in the Midwest and the Southeast regions. We have, I think, about 5 deals under management right now. We're getting ready to add a 6th deal. We've done a dozen deals total, so we've exited 6 deals.
Okay.
Our focus really is kind of a 2-hour radius of the Cincinnati market. So think Columbus, Cincinnati, Indianapolis, Louisville, Lexington. Those are areas where me and my team are taking the lead. Outside of that, we still love the Southeast. So we're partners on a deal in North Carolina. We've got one in Atlanta. We have one in Atlanta, North Carolina, and then we have one in Florida as well. So for us, we're constantly looking at those markets that are seeing great growth. But the reality is, for me to try to get a deal and win a deal in those markets, that's stretching ourselves kind of thin, and we try to keep our team somewhat lean. So for us, it's better to partner with other operators who are in those markets, who understand those markets, that have relationships with the brokers, and then and people that we've gotten to know over the years, because we've had the pleasure and the opportunity to get to connect with a lot of different people. So we can cherry pick the operators that we want to partner with. So for us, that's kind of our approach, and it works really well, where we have kind of the deals that we kind of lead and run ourselves, but also deals that we partner with other operators.
Yeah, no, I think that's a great way to do it. And you mentioned the podcast and kind of getting the interaction that way. That's what I'm enjoying about the wealth flow, is just the opportunity to talk to different operators and kind of hear what they're doing and see if there's any that I want to partner with as well. So that's good. Tell me maybe a little bit about, from an investment standpoint, what you guys target. Are you looking at value add? What class of apartments are you buying, and kind of what are the strategies around them?
Yeah, definitely value add. And I think it's really important to understand what strategy makes the most sense for any deal or any market. So because we're in the Midwest and even some of the Southeast markets, they don't tend to go up in value as drastically as maybe some of the coastal markets. They also don't go down in value as drastically.
Right.
So you don't have the wild swings. It's pretty, consistent. I joke that, Cincinnati, where I live, it's a very stable market. And part of what that means is we're going to get our rent growth after some of these other markets have seen their rent growth, but it's not going to go down as quickly. So when I first started investing in Cincinnati, it was ranked as the most affordable market in the country. So basically, a huge upside is the way I looked at it, right? You can look at it 2 ways, but I looked at it as there's literally no major metro cheaper to live in than Cincinnati. Yeah. So it's not like you're going to raise the rents and people are going to say, oh, I'm out of here, I'm moving to Indy. It's like, no. So there's room to go up, right? Versus, then again, I was living in Chicago at the time. So I'm like, okay, that makes sense to me. So that was one thing I liked, that there was upside, especially when you look at comparable markets like Cleveland, Detroit, and Indianapolis and Lexington and Louisville and stuff like that. So I like that about the market. But I would say, as an investor, we have to plan for cash flow first and foremost. So we like to see deals where we can get cash flow out of the gate. We want to make sure that we are driving great operations, but we're going to be a bit more conservative on our back end projections and our exits. So it's more about, does the deal work while we're holding it? And then we want to sell when it makes sense to sell, not necessarily, hey, we're going to buy this thing and we're out of this in 24 months or 36 months. So that's one of the ways we like to think about it: cash flow first, cash preservation. And then obviously we want to buy in areas where we can get that upside projection as well. We are doing value add deals. We like to do light to medium value add. We will consider heavier value add opportunities, again, if we feel like we have the right team in place to execute. But it really comes down to that deal and that opportunity specifically.
Okay. Yeah. And as far as number of units that you're targeting now, what range as far as number of units?
So typically we're looking at 75 to 200 units, but we are getting really excited about opportunities kind of that call it 40 to 75 unit range, right? It's usually too small for the bigger institutional type investors. Out of town guys don't really like that size as much. And we've got pretty good boots on the ground. So we feel like we can be more nimble and navigate some opportunities there. So we're getting ready to do a deal in one of those cities, Columbus in particular. And one of the things we're excited about is it's a smaller deal. And we're going to partner with the team that's going to operate it. They're vertically integrated. And that's going to allow us to be more nimble than we could ever be. And, those are the kind of advantages we're looking for in this current market environment, because it takes a certain level of, nimbleness to execute all these smaller deals. And for us, it's not just going smaller to go smaller. It's if you can cobble 3, 4, 5 of these deals together, then essentially you can have the same impact of having a 200 unit complex. But you have, 350 units or 450 unit deals. So that's the way we're thinking about it and trying to approach it, where we can be somewhat nimble and effective as opposed to just competing with everyone else.
Yeah, there's a lot there. I think that's a great strategy. And like you said, if you're doing it all within a collective area, you still have the ability to scale, even by buying something that's a little bit smaller than some of the other ones that you have. It just becomes part of what you have to offer potential tenants. So that's great. Any other strategies, anything else that you do to try to build the value and increase the NOI for your investors?
I think the biggest thing we're always looking to do is understand the story. And, I know a lot of people just want to underwrite and look at the numbers, but, logic is really important. Just taking the time and understanding what has happened at the property. Why is it in whatever condition it's in now? Where is the opportunity? And then what's the business plan? So again, this is where maybe my business and marketing background comes in, but, we always want to look at it. What's the story here? What's the story? What do we think the opportunity is? What's the hypothesis? And then we want to test it out. And I'll give you a prime example. Someone presented a deal to me, last week, and it had changed hands twice in the last 3 years. And I said, that's a red flag for me, right? Why has this been sold twice in the last 3 years? And now this looking to sell for a third time in 3 years, right? So I'm like, that seems really concerning to me of why this would be trading that many times. So is it because they're just slipping it? They've made their money and they're kicking it to the next person. Is there value add opportunity left? Is the market getting tight? Are they concerned with interest rates? So they're just trying to get it off their books now. I'm trying to understand what's the reason this is selling and continuing to sell. Because if it's a great asset, investors usually want to hold that long enough to extract enough value and then sell it, not necessarily, once a year. So that was a little concerning to me. I want to understand that. And then I also want to make sure that we are humble in our approach. I don't want to assume, oh, okay, well, hey, it's a great deal. We're going to come in and we're going to do our business plan and we're going to push rents $250. Well, wait a minute. How come the current guy isn't pushing it $250? And it just needs to make sense. I'm not saying he can or can't, but I don't want to overestimate our abilities without really understanding the picture. Maybe there's a barrier that we're not aware of. Maybe, and that barrier could be the current resident base. So it's just to say that, okay, hey, we can push it, but it's going to take us some time because we got some residents here who nobody wants to live next to. So you're going to have to flush that resident base out, turn it completely before you can get $250. So for us, it's more putting together a business plan based on what we actually see and going from there. And we you learn these lessons sometimes the hard way and sometimes off of the backs of other people. And I've been blessed to do 500 podcast episodes. So I've learned a lot from those individuals. But unfortunately, I still have to learn the hard way on some of these too, right? We had a deal where we thought we could come in and push rents and turn the units, and we were right. But the thing we didn't account for was when you go in and you renovate a unit and you put $10,000 into that and you make it really nice and you bring in a new resident. If you haven't changed the rest of the clientele, well, that experience is going to suck for that new resident. And they're going to look at this and say, wait a minute, I'm paying X and I got to deal with this crap next door and people throwing trash everywhere and cops coming. That's not going to fly. And you're going to lose those new residents. And we didn't realize that and factor that in. And we had to kind of reboot our entire business plan. So those are the things that, again, you can go on your fancy spreadsheets all you want, but at some point you've got to be very practical with what does this experience look like for us as operators, for the property managers, and then also the residents. And all of that has to come together to make a great deal and a great opportunity.
Yeah, I agree. And I think that's smart. And yeah, I mean, some of it you can study it and you can have a mentor, but at the end of the day, you also need to jump in, and there'll be some mistakes that you make, but having that mentorship and having somebody to follow and somebody to partner with just kind of helps minimize the risk and the opportunity for those mistakes. So,
Absolutely.
But some of it you just got to learn.
And I would tell people there's two great pathways, in my opinion, to get into larger multifamily. One is invest passively. The reason I love investing passively and then deciding to be more active or be a general partner is you want to confirm this is actually what you want to do. I think people assume that, folks in this space, we're out here making great money and we're doing all this stuff. And it's, I can do that too. And you probably can do it, but it's work and it's a job. And make no mistake about it. We offer a service. It's a job. We are great. We're happy to work with our clients and our investors, but it's a service. So you may realize you actually don't want to do any of that work and you really just want to get the returns. And it would help you to learn more about what it actually entails and see some of the updates and be involved. The other reason is it's going to be much easier to get people involved in something you're already doing. If you are investing in these deals and you're sharing with other people that, hey, I'm investing in this deal, are you interested in learning more? Or if I have another opportunity, do you want me to share it with you? People are going to be more receptive to that than you saying, hey, I'm about to syndicate my first deal. Never done this before, but do you want to invest in my very first deal? Probably not. Right. So I say start on the passive side, and that way you can just share your experience. The other way is, like you alluded to, is hiring a mentor. Hiring a mentor, I think is really key because you can learn off the back of someone else. You can have someone on your team that you can ask direct questions to and really kind of get that knowledge that is harder to come by. There's only so much you can learn from podcasts and books, and a lot of it is real world experience, but it's also situational. And the reality with real estate is everything is situational, right? And it's just, you got to look at the exact situation. What's the challenge? Again, what's the story? What's the opportunity? And then you got to put together the right plan based on those things. And it helps to be around people who have seen a thing or two so they can give you the direction and feedback necessary to make good decisions.
Yeah. And so as far as mentorships go, are there any that you've used for, personally that you recommend, or what advice could you give there?
Yeah, I would say, again, I think it's really important for people to commit. What I mean by that is to say, if you are still trying to figure out if this is something you're interested in, don't go out and spend $50,000 on a mentor, right? Because nothing's worse than spending that kind of money and you're realizing you're not going to commit to the next steps of what you need to do to see real success. So figure out, how committed are you to this? If you're gung-ho committed and you're quitting your job and you're pushing all the chips in on this, by all means, continue to do that, get the right mentor and move forward. If you're not in that space yet, what I would suggest is take a smaller step forward. And one way to do that is by joining a mastermind. We actually just launched a mastermind that is helping people learn how to invest in commercial real estate, particularly multifamily, how to raise capital for deals, how to analyze deals, and all those things. So that may be an option for you. As far as the path I took, I did hire a mentor, and I hired a mentor who could help me with something very specific. I had some experience with smaller multifamily. I had done my first commercial deal, so I, kind of checked that box, but I had never raised money for deals. And I was concerned about losing anyone else's money. My money, no, I don't want to lose my money, but I knew the risk I was signing up for. But in bringing in someone else, I took a great deal of respect with other people's money. And maybe some of that goes back to the childhood we talked about and respecting a dollar earned, knowing what people sacrifice to make money. I take that to heart, right? And anyone who invests with me, they believe in me, and I want to pay them back, or pay them for believing in me. I want to give them that return. I want them to feel like that was a great experience. John is someone that you can invest in. Because of that, I wanted a mentor because I wanted someone in my corner to help me protect those investors. That was very, very important to me. And that's why I hired an investor or a mentor. I would say, figure out what your strengths are, figure out where you need help. And then based on where you need help, if you need to go hire a mentor to help you with that, go get that help. Maybe it's analyzing deals, maybe it's raising capital, but figure out what it is and then find a mentor who can help you down that path. And if you're not quite sure yet, again, joining a mastermind is going to be more, affordable and cost effective. And as you go through that and take the next step forward, I think you can get clarity on your journey.
Yeah, I think that that's great advice. And as far as a mastermind goes, maybe if you can speak a little bit more to that. I'm in masterminds as well, and prior to being in them, I'm like, what is this? Mastermind thing? It's like a couple people in a room trying to decide how to take over the world, or what is a mastermind? Exactly. So what are some of the benefits that you've seen from it?
Yeah, I mean, there are all sorts of different types of masterminds, but for me, the biggest benefit is one, being around people who are committed to growing in this space. I think the biggest success I've had, or said differently, the biggest reason for any successes I've had in this space have been based on the people I've surrounded myself with. And it goes back to that mindset. If you are surrounding yourself with people who are playing this game at a certain level, it's going to elevate the way you think about it. They say you're the average of the 5 people you spend the most time with. So if you want to change your lifestyle, if you want to be a more whole person, find people who are playing life at a level that you want to mimic. So success leaves clues. You just have to figure out what these individuals are doing and copy that. So being in a mastermind allows you access to people that maybe you wouldn't have access to. It allows for conversations to happen in a way that is more organic. It allows for different point of views. So different from like just one-on-one coaching in a mastermind. If you got 10, 15, 20, 30 people in this room, well, some people may feel a certain way. Some people may feel differently. So you get a little bit of friction, and that friction is great because it allows for you to have more complex conversations that allow you to really reach your end goal. I will tell you, there's so many people I know in the space who they start, investing in one asset class or investing as an LP or investing as a GP. And then as they go on a year, 2 years later, they're doing something very different. Why? Well, they've gotten feedback and they've realized maybe what they really enjoy or what they're good at or what they don't want to sacrifice. And they've been able to make adjustments accordingly. So being around these people, and it allows you to just get different ideas and get different perspectives. And I think that can be very helpful for people. Like anything else, you get out what you put in. So if you're going to be in a mastermind, be present, ask questions, get feedback, share the challenges you're having. All of those things are going to help you see success. And you're going to get feedback from people who have been in your shoes and may give you different opinions, but you'll get some feedback. And I think that's really important for anybody looking to take that next step in their own financial journey.
Yeah, I think so too. And just being, like you mentioned, just being in the room with people. A lot of us have certain aspirations, but I know, I just look at my own self, and you reflect back on many of the friends I grew up with and stuff. If I was to say, oh, I want to get into multifamily and I want to do this, it's almost like, really, it's almost like you're bragging, right? Like, I'm going to do this. This is what I'm going after. And I found that at least in the mastermind, kind of everybody is after something, and it's very like-minded people. And instead of maybe a challenge to what you're hoping to do, you're also getting support from those people as well.
And that's so critical, especially when you're starting out. Those RIAs that I attended, while they weren't masterminds, they were critical, because when you work a W-2 job and you even remotely start to share aspirations of investing in real estate, but the people you're talking to have never invested in real estate, have no desire to invest in real estate, they just want to party and drink or get their next promotion. You realize those conversations start to stall, and worse, they can dissuade you from pursuing that. Oh man, you want to do that? Man, I don't know, man. I heard interest rates are crazy right now. Or, do you see this article? This person just lost all this money. And it's easy to get that kind of feedback and see the fear, because that's what other people are going to have. And that's based on their own experiences. But when you're in a room filled with other real estate investors, well, they can address those questions or those issues directly and then work around it. I was, just before we got on this, I was doing another interview and someone asked me if I had read this article that came out recently. And I had started reading it, and they made a post about it. And I was just kind of talking to them about their post. And the bottom line is, it's people see what they want to see. If you are scared about investing, if you have apprehension, if you have a spouse who maybe has had a negative experience or doesn't trust the way you think about it, maybe you invested all your life savings in crypto and that blew up, right? Like, if that's the way you approach it, then you're going to see fear and you're going to see the negative in various opportunities and situations. Versus if you're optimistic, if you're focused on understanding how to identify the issues and how to overcome those issues, and surrounding yourself with people who can help you overcome those challenges, then you're going to be more, in line to move forward and address those issues. And I see that a lot with couples, where, one person really wants to invest, the other person doesn't because they have a different issue. Maybe you're a saver and you don't believe you should be spending money like this. You should save your way to, I don't know, something, but you're not going to get there saving, right? So it's all about the mentality. I think surrounding yourself with people who are like-minded, but not necessarily just people who are going to say the same thing. Like, I think friction is really good. You should have people who have differing opinions, whether it's on using floating debt or fixed debt. Like, if you only hear one voice and one side of the coin, then I would probably grow a little concerned with that. But I want to hear the different perspectives so that I can identify what the truth is for me based on those directions and feedback, and then make informed decisions with all that information.
Yeah, for sure. No, I think that's all great stuff. Let's maybe go to how people can find out more about you, and then I've got a couple more questions for you.
Yeah, a couple things. So one, we've got our podcast. It's called Multifamily Insights. It's available anywhere you listen to podcasts. If you are interested in investing in real estate, whether on the active side or on the passive side, I find that a lot of people don't understand some of the terminology or deal structure and stuff like that when it comes to it starting out. So we put together a sample deal package. It's on our website. Just go to casmoncapital.com/sample deal. And when you download the sample deal, you'll get more insights from us on what we look for in opportunities, the kind of questions you need to be asking yourself before you seriously explore any opportunity as well. So it's a really good resource just to help you wrap your head around terms, deal structure, things like that. Again, that's at casmoncapital.com/sample deal.
Perfect. All right. And let's see. I got a couple other questions for you, and I've enjoyed our time together. I think it's been great. I think you've added a ton of value. But I've got, if you were just starting out, what advice would you give yourself now that you've gotten your experience, right? So for somebody that maybe is just starting their journey on success, what are some things that you would give them?
So starting out, I'm assuming I still have my W-2 job, right?
Yeah.
Okay. If I could go back to when I had my W-2 job and I was starting out, I would invest passively with a group that I believed in. I would take my time to get to know a couple groups, but I would find a group that I believed in. I would invest passively, and I would learn as much as I could about how they're doing, what they're doing, how they communicate. And I would use that experience to kind of springboard my own opportunities. Yeah,
I think that's great. What about a book recommendation, John? Any great books you've read just recently? You can throw a couple of them out.
On productivity, my favorite is Atomic Habits. That's a great book. That is. Tiny Habits is another very similar book. Who Not How's another great book. There's a book I don't know, man, I could go on and on. Grit is one that, I'm a parent, so anyone who's got kids, I think there are books like Grit or Mindset, Growth Mindset by Carol Dweck. Those are really good books for not just yourself, but I think if you're trying to help younger people, if you coach kids, anything like that, that's really powerful just to help give them the resources and tools so that they can see the kind of results they're looking for in their life. So those are, I think I gave you 4, so I'll stop there.
Okay. Sounds good. No, all great recommendations for sure. And I guess outside of investing in real estate, your involvement in the multifamily stuff, what does John like to do outside of that? You have a wife and family, and what What does that look like?
Yeah, man. I've got two boys who are with grandparents right now, but they'll be coming back this weekend. But I am
Nice.
pretty actively involved in their lives. So coaching my youngest son in football and wrestling. And then my oldest is playing soccer. So, trekking around with him into his soccer matches and stuff like that. So just being a present dad is really the biggest thing, outside of the parental things. I am a terrible golfer, but I do enjoy going out there and chopping at some grass, and just try to stay fit. I do work out pretty much every day, 5 or 6 days a week. So that's a big part of it. And a lot of it just comes down to active lifestyle, but also mentality. If you can get up at 5 a.m. and get a workout in, you got to win on the board, and not just to win physically, but mentally. It's like, okay, I'm a former wrestler. So for me, all this is mental. And, if I can get up and do something I think is hard for most people, then it gives me just a little bit of edge to continue to push throughout my day and try to do something that's hard. So I just think that's really important in life, is figuring out how do you get a little bit of an edge. And sometimes you got to make up stuff to keep you motivated, but trying to keep your eye on the prize.
Yeah, for sure. That's all good. Well, John, I appreciate our time together, and I just thank you so much for being on the show.
I appreciate it. Thank you for having me. Great conversation, and I look forward to staying in touch with you.
Absolutely.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.